It's been quite an interesting time. Markets have staged a remarkable recovery. We're just looking at the end of April figures, and stock markets have had quite a good month in April. Bizarrely, it doesn't feel that way, especially against the backdrop of the economic numbers coming through. And the numbers that you see in the paper are they're just horrible. It's the worst time since 2008, or the worst time since the Second World War, or the worst time since the Great Depression. Markets have moved on from that. They're looking through this. We may come on to it later, but this downturn has been, in some ways, it's similar to others, but in many ways, it's very different to other downturns. And what we're seeing is that fund managers, markets, investors are disregarding the news that's coming out because it's just horrible. But they're looking through the first quarter, which is history, the first 3 months of the year. They're pretty sure that the second 3 months of the year to the end of June aren't going to be great. But they're looking to the second half of the year and the beginning of 2021. And what they're seeing is, this massive amount of stimulus that has been, if not already thrown at the markets, it's been promised to the markets. So we've had central banks, we've had governments around the world acting in tandem. So just as the shutdown was sort of coordinated and happened all at once, so the policy response has been coordinated and is happening globally all at once. And no one's entirely sure how it's going to work out. There's still an awful lot of uncertainty out there. But there is now a sense of the markets looking through the current difficulties of what might happen in the second quarter, but particularly the second half and out to 2021. So April, wasn't a bad month, and the two potential portfolios held up very well. I think, as everyone knows, there's an awful lot in there. Our great mantra is diversification, and that's what's seen us through the worst of this downturn. So if we look at April's figures, which have just come through, the defensive portfolio was up 2.5%. The balanced portfolio was up, I'll just check my numbers, up 5.5%. And the aggressive portfolio up 6.5%. Now there's all sorts in there. There's bonds, there's gold, there's silver, there's as well as US equities, European equities, Japanese equities, UK equities. But those figures, sort of 2.5 for defensive, 5.5 for balanced, 6.5 for aggressive, compare. I think most people use as their anchor point the FTSE 100. It's what we see on the front of the paper. It's what we hear on the telly. Billions wiped off share prices. What's happened to the FTSE? Well, the FTSE was up 4.5%. So we've performed well relative to that index, which isn't representative of the portfolios, but it does give a sense of how we've performed. Year to date, yes, the numbers are horrible. The FTSE is down, I think, nearly 21% to the end of April. Our balanced portfolio was down 10%. Now, no one likes a fall of 10%, but compared to a fall in the stock market of over 20%, that's not a bad outturn, and it just speaks to the whole theme of diversification that is, runs throughout the whole True Potential offering.